Hello and welcome to our news video. Subscribe to our channel and share your comments so that you don't miss any important news. Easing inflation may spark a new Bitcoin rally, says 10x research analyst. Trump eyes Brian Quintenz as next CFTC chair amid pro-crypto regulatory shift. Goldman Sachs expands its crypto ETF portfolio. Ethereum exposure surges 2,000% while Bitcoin holdings exceed $1.5 billion. Franklin Templeton registers Franklin Solana Trust in Delaware, poised to launch spot Solana ETF. Coinbase set to report 109% YOY revenue growth in Q4 as trading volumes surge. Easing inflation may spark a new Bitcoin rally, says 10x research analyst. Crypto market dynamics are once again in the spotlight as analysts predict that a lower-than-expected U.S. Consumer Price Index (CPI) print could trigger another rally in Bitcoin. According to Marcus Thielen, head of research at 10x Research, there is a real possibility that the upcoming CPI report, set for release on February 12, might come in below consensus expectations. Such an outcome could provide the catalyst for renewed bullish momentum in Bitcoin, defying the prevailing market sentiment that anticipates a steady inflation figure. Market expectations and the CPI outlook. Most market participants have been forecasting a year-on-year inflation rate of approximately 2.9% in the upcoming report from the U.S. Bureau of Labor Statistics. However, recent data from the U.S. Truflation Inflation Index, a real-time inflation tracker, has shown a marked decline from 3.0% to 2.1%. Thielen suggests that this significant drop may indicate that inflation pressures are easing more rapidly than many had anticipated. If the CPI surprises to the downside at around 2.7% or 2.8%, it could ignite another rally attempt in Bitcoin, Thielen stated in a market report released on February 11. Such a scenario would contradict the majority consensus, offering a relief rally opportunity for investors who have been waiting on the sidelines amid uncertainty. Historical precedents and potential rally dynamics. The potential for a bullish turn in Bitcoin is not without precedent. In January, when market participants braced for a third consecutive month of rising inflation, the release of a 2.9% inflation print, unchanged from December, took many by surprise. This unexpected outcome helped to relieve the market, spurring a significant rally that saw Bitcoin's price surge by approximately $10,000 and push above the critical $100,000 threshold. However, subsequent external factors, such as tariffs imposed by former President Donald Trump on Canada, Mexico, and China, interrupted this upward momentum. Analysts now posit that a similar rally could propel Bitcoin from its current trading level. Presently, Bitcoin is trading at around $95,490, representing a decline of about 2.65% over the past week according to CoinMarketCap. A subsequent rally of roughly $10,000 could elevate Bitcoin to approximately $105,491, which is just 3.5% below its all-time high of $109,000, a level briefly reached on January 20 ahead of Trump's inauguration. Investor sentiment and polls. Investor sentiment appears to be cautiously optimistic. Benjamin Cowan, founder of Into the Cryptoverse, conducted a poll on X, formerly Twitter, on February 11, asking where participants expected Bitcoin's price to move following the CPI release. Out of 12,397 respondents, 51.7% anticipated an upward movement in Bitcoin's price, reflecting a modest yet significant bullish bias among crypto enthusiasts. This sentiment is further reinforced by observations from other industry experts who believe that easing inflation could create a conducive environment for crypto investments. Broader implications for the crypto market. The potential for a lower CPI print and the corresponding Bitcoin rally has wider implications for the overall crypto market. As inflation pressures ease, investors might gain confidence in taking on more risk, which could lead to increased liquidity in the crypto markets. This environment would not only benefit Bitcoin but also stimulate growth in other areas of the digital asset ecosystem such as decentralized finance, DeFi, non-fungible tokens, NFTs, and Web3 applications. Furthermore, MN Capital founder Michael van der Poppy recently expressed optimism, suggesting that Bitcoin could reach new all-time highs within weeks, drawing parallels to the recent sustained rally in gold. Such positive outlooks may encourage both retail and institutional investors to re-engage with the market, potentially driving prices higher as demand outpaces supply. The possibility of easing inflation also ties into broader macroeconomic trends. With central banks worldwide adopting more accommodative monetary policies after years of tightening, a lower CPI could signal that economic conditions are stabilizing. This stabilization, in turn, might lead to a shift in investment flows towards high-growth assets like Bitcoin, as investors look to capitalize on improved market sentiment and reduced volatility. Technical perspectives and future price targets. Technical analysis further supports the prospect of a potential rally. Analysts note that if the CPI print indeed surprises to the downside, it could provide the necessary impetus for a renewed bullish trend in Bitcoin. Historically, favorable inflation data has been correlated with strong market rallies in the crypto space. A rally of approximately $10,000 in Bitcoin's price would bring it tantalizingly close to its previous peak, suggesting that the cryptocurrency is nearing a critical juncture. Such a rally would not only restore investor confidence but could also set the stage for sustained upward momentum, especially if accompanied by positive macroeconomic data and robust institutional support. As the market awaits the CPI report on February 12, all eyes are on the inflation numbers. A lower-than-expected reading could trigger a cascade of positive reactions across the crypto market, potentially igniting a rally that propels Bitcoin, and possibly other digital assets, into new territory. With major players and institutional investors closely monitoring these developments, the coming days will be crucial in determining the next phase of the crypto market's evolution. Trump eyes Brian Quintenz as next CFTC chair amid pro-crypto regulatory shift. In a significant move that could reshape the future of cryptocurrency regulation in the United States, President Donald Trump is reportedly preparing to nominate Brian Quintenz, currently the head of policy for Andreessen Horowitz's A16Z crypto division, as the next chair of the Commodity Futures Trading Commission, CFTC. This nomination, disclosed in a document sent from the White House to Capitol Hill on February 12, underscores a potential pivot toward a more crypto-friendly regulatory framework in the U.S. A new era for the CFTC. According to multiple sources, if confirmed, Brian Quintenz's appointment will likely signal a robust pro-crypto policy agenda for the CFTC. Quintenz, who previously served as a Republican commissioner of the CFTC during the first Trump administration between 2016 and 2020, is well known for his forward-thinking stance on digital assets. During his tenure, he championed the integration of digital asset derivatives and crypto products into the federal regulatory framework, advocating for innovation and modernization in the industry. His past criticisms of the Securities and Exchange Commission, SEC, are noteworthy. In March 2023, Quintenz publicly denounced the SEC's approach to the legal status of Ether, ETH, arguing that the agency's inconsistent treatment of the cryptocurrency was problematic. He pointed out that the SEC had acknowledged ETH as a non-security asset when it approved Ether futures exchange-traded funds, ETFs, in October 2023, a move that, according to Quintenz, would not have occurred if the SEC had any lingering doubts about its regulatory treatment. His outspoken views suggest that under his leadership, the CFTC could become the primary regulator for the crypto industry, potentially overshadowing the SEC in this rapidly evolving sector. Key implications of the nomination. The potential nomination of Quintenz is part of a broader strategy to recalibrate the regulatory environment in favor of digital innovation. Not only does it mark a return of a familiar face to the CFTC's policymaking circle, but it also highlights the administration's intent to support the growth of crypto markets. With Quintenz at the helm, it is widely expected that the CFTC will pursue policies that facilitate the introduction of innovative crypto products and derivatives, ensuring that the United States remains at the forefront of global financial innovation. Industry insiders believe that this appointment could bolster confidence among crypto market participants, as regulatory clarity and a pro-crypto stance have long been touted as essential for the sector's sustainable growth. Moreover, it could help establish the CFTC as the leading authority in crypto regulation, offering a counterbalance to the SEC's traditionally conservative approach. Other notable nominations in Trump's regulatory shakeup. The document that revealed Trump's intention to nominate Quintenz also disclosed other high-profile picks aimed at reshaping the nation's financial oversight. Notably, President Trump has nominated Jonathan Gould, a partner at the global law firm Jones Day, to serve as controller of the currency, the official responsible for regulating all U.S. national banks. In another significant appointment, Jonathan McKernan, who resigned from the Federal Deposit Insurance Corporation on February 11, has been tapped as the new permanent head of the Consumer Financial Protection Bureau. These nominations indicate a sweeping effort by the administration to overhaul financial regulation and streamline oversight across multiple sectors. Brian Quintenz's background and industry impact. Brian Quintenz is no stranger to the intersection of regulation and crypto innovation. Before his current role at A16Z, his experience as a CFTC commissioner equipped him with a deep understanding of the regulatory challenges facing digital assets. His tenure was marked by an eagerness to integrate crypto derivatives into traditional financial markets, and his policy positions have consistently reflected a desire to reduce regulatory friction for emerging technologies. Andreessen Horowitz, one of the largest venture capital firms in the crypto industry, has been a significant supporter of innovation in digital assets. The firm funds a wide array of startups and projects, including industry leaders like Maker, Now Sky, Solana, Avalanche, Aptos, AgentLayer, Lido, Nansen, OpenSea, and Coinbase. With Quintenz at the regulatory helm, expectations are high that there will be greater flexibility for experimentation within the crypto space, a sentiment echoed by A16Z in recent statements regarding a more accommodating regulatory environment under the new Trump administration. Looking forward. The nomination of Brian Quintenz as CFTC chair is poised to become a defining moment in the ongoing debate over how best to regulate the crypto industry in the United States. As the Trump administration works to implement its vision of reduced regulatory constraints and enhanced innovation, Quintenz's potential appointment may provide the necessary leadership to navigate the complex landscape of digital assets. His track record suggests he is well positioned to advocate for policies that encourage growth while ensuring that the United States remains competitive in the global financial market. Industry experts and market participants alike will be watching closely as this nomination moves through the confirmation process. Should Quintenz secure the position, it could herald a new chapter in crypto regulation, with the CFTC taking a more prominent role in shaping the future of digital asset markets. Goldman Sachs expands its crypto ETF portfolio. Ethereum exposure surges 2,000% while Bitcoin holdings exceed $1.5 billion. Investment bank Goldman Sachs has made significant strides in its cryptocurrency portfolio during Q4 2024, dramatically increasing its exposure to both Ethereum and Bitcoin exchange-traded funds, ETFs. According to a recent Form 13F filing with the Securities and Exchange Commission, SEC, dated February 11, Goldman Sachs boosted its spot Ether ETF position by over 2,000%, taking its holdings from a modest $22 million to an impressive $476 million. Concurrently, the firm's Bitcoin ETF investments have more than doubled, rising by 114% to surpass $1.5 billion in total value. Dramatic surge in Ethereum ETF holdings. Goldman Sachs's aggressive expansion in the Ethereum market is evident from its strategic allocation across multiple Ethereum ETF products. The bank's recent filings reveal that its $476 million Ethereum ETF exposure is distributed nearly evenly between BlackRock's iShares Ethereum Trust, ETHA, and Fidelity's Ethereum Fund, FETH. Additionally, Goldman allocated an extra $6.3 million into the Grayscale Ethereum Trust ETF, ETHE. This considerable increase, marking a surge of over 2,000% compared to previous quarters, highlights the firm's bullish outlook on Ethereum, bolstered by the rising adoption of digital assets and the growing confidence in blockchain technology. Market data indicates that the price of Ether has contributed significantly to this strategic move, with ETH experiencing notable price appreciation during the quarter. The substantial increase in exposure underscores Goldman Sachs's belief in the long-term potential of Ethereum as a key component of the digital asset ecosystem. Robust growth in Bitcoin ETF investments. In tandem with its Ethereum strategy, Goldman Sachs has also bolstered its Bitcoin ETF holdings substantially. The firm's Bitcoin portfolio now exceeds $1.5 billion, with a notable portion, approximately $1.28 billion, invested in shares of BlackRock's iShares Bitcoin Trust, IBIT. This figure represents a 177% increase in IBIT holdings compared to Q3 2024. In addition, the bank invested about $288 million in the Fidelity Wise Origin Bitcoin Fund, FBTC, further diversifying its Bitcoin exposure. The Form 13F filing also reveals a modest holding of $3.6 million in the Grayscale Bitcoin Trust, GBTC, reflecting Goldman Sachs's broader commitment to the crypto space. This expansion in Bitcoin ETF investments has been partly fueled by rising market prices, with Bitcoin's value increasing by approximately 41% over the quarter. Such market dynamics have enabled Goldman Sachs to capitalize on the upward trend in digital asset valuations, reinforcing its strategic shift toward institutional crypto adoption. Market environment and strategic repositioning. Goldman Sachs's enhanced ETF positions come amid a broader trend of institutional interest in cryptocurrencies, driven by an increasingly favorable regulatory environment and robust market performance. The investment bank initially entered the spot crypto ETF market in the second quarter of 2024 with a reported purchase of $418 million in Bitcoin ETFs. The recent aggressive expansion across both Bitcoin and Ethereum ETFs signals a further deepening of its commitment to digital assets. The rising valuations of Bitcoin and Ether during Q4, recorded at 41% and 26.3% increases respectively, have undoubtedly contributed to the decision to increase ETF holdings. As these assets appreciate, larger positions become more attractive for institutional investors looking to gain exposure without the complexities of direct ownership. This trend reflects a broader institutional move towards leveraging regulated investment products, such as ETFs, to participate in the crypto market with enhanced transparency and reduced counterparty risks. Shifting institutional sentiment and future prospects. The recent moves by Goldman Sachs are indicative of a wider shift on Wall Street towards embracing cryptocurrencies as a legitimate asset class. While the bank has been a vocal critic of crypto in the past, publicly asserting that digital currencies are not a suitable investment for its clients, its current portfolio adjustments suggest a strategic pivot driven by market realities and client demand. This change of heart is underscored by remarks from key executives. For instance, Goldman Private Wealth Management's Chief Investment Officer, Sharman Mossavar-Amani, had previously compared the crypto craze to the tulip mania of the 1600s, yet recent investment decisions paint a different picture. The firm's renewed enthusiasm for crypto ETFs, particularly in Bitcoin and Ethereum, may be seen as an attempt to capture growth in a sector that continues to attract significant institutional capital. With major asset managers and financial institutions increasingly participating in the digital asset space, Goldman Sachs appears to be positioning itself to not only benefit from current market trends but also to lead the institutional transformation of the crypto industry. In addition to expanding its ETF holdings, there are reports that Goldman Sachs is considering the launch of its own crypto platform. This initiative would enable its partners to trade financial instruments on blockchain-based rails, further integrating traditional finance with the emerging digital economy. Such strategic developments could redefine how institutional investors interact with cryptocurrencies, offering more streamlined and secure channels for accessing this dynamic market. Diversification of crypto exposure and strategic impact. Goldman Sachs's reallocation and expansion of its crypto ETF positions reflect a deliberate effort to diversify exposure within the digital asset space. By increasing holdings in both Ethereum and Bitcoin ETFs, the firm is hedging its bets on the broader adoption of blockchain technology and the sustained growth of these leading cryptocurrencies. The decision to concentrate investments in well-established ETF products from industry leaders such as BlackRock and Fidelity further underscores the bank's confidence in the stability and long-term viability of these assets. Furthermore, the strategic exit from Bitcoin ETF positions associated with providers like Bitwise, WisdomTree, Invesco, Galaxy, ARK, and 21 Shares suggests a consolidation of its portfolio towards offerings that it perceives as more robust and better aligned with its investment philosophy. This portfolio realignment is expected to enhance risk management and improve the overall performance of Goldman Sachs's crypto investments. As regulatory frameworks continue to evolve and institutional adoption of cryptocurrencies accelerates, the moves made by Goldman Sachs in Q for 2024 are likely to have far-reaching implications. By significantly increasing its exposure to both Ethereum and Bitcoin ETFs, the bank is not only capitalizing on current market momentum but also setting a precedent for other institutional investors to follow. The ongoing transformation in the crypto investment landscape signals a new era where traditional financial institutions are increasingly willing to embrace and integrate digital assets into their portfolios. Goldman Sachs's recent strategic maneuvers in expanding its crypto ETF holdings reflect a broader industry trend of growing institutional interest and increased regulatory clarity. The firm's enhanced positions in Ethereum and Bitcoin ETFs underscore its belief in the transformative potential of digital assets, positioning it as a key player in the evolving crypto market. Franklin Templeton registers Franklin Solana Trust in Delaware, poised to launch spot Solana ETF. Asset management giant Franklin Templeton has taken a significant step toward expanding its digital asset offerings by registering a trust in Delaware tied to a proposed spot Solana exchange-traded fund, ETF. The new entity, dubbed the Franklin Solana Trust, was officially formed on February 10 by the CSC Delaware Trust Company, a firm experienced in registering crypto trust products for other major asset managers, including Bitwise. This registration suggests that Franklin Templeton may soon join a competitive race alongside Grayscale, Bitwise, VanEck, 21 Shares, and Canary Capital in launching a spot Solana ETF in the United States. Details of the trust registration and upcoming filing. The recent filing with Delaware's corporate regulator confirms the formation of the Franklin Solana Trust, a clear indication of Franklin Templeton's intention to tap into the rapidly growing market for digital asset investment products. To move forward, the asset manager will be required to file two key documents with the U.S. Securities and Exchange Commission, SEC Form 19B-4 and a Form S-1. These filings are standard requirements for launching an ETF and will formally initiate the process to list a spot Solana ETF on a major exchange. Although the registration document did not specify which exchange would host the fund, it is noteworthy that Franklin Templeton's current spot Bitcoin and Ether ETFs are both listed on the CBOE-BZX exchange, suggesting a potential similar route for the new Solana offering. Market implications and industry context. If approved, the Franklin Solana Trust would track the price movement of Solana, SOL, the world's fifth largest cryptocurrency by market capitalization, which CoinGecko currently estimates at around $97 billion. The proposed ETF aims to provide institutional and retail investors with a streamlined vehicle to gain exposure to Solana without having to purchase the digital asset directly, thus mitigating some of the complexities and risks associated with direct crypto ownership. The filing comes at a time when the digital asset industry is experiencing robust institutional interest. Bloomberg ETF analysts James Seifert and Eric Balchuners commented on February 10 that the odds of a spot Solana ETF receiving regulatory approval before the end of 2025 are around 70%. They noted that these odds have increased dramatically following significant market developments, including a surge in interest after former President Donald Trump's election win in November. However, Seifert cautioned that the SEC must first resolve questions regarding Solana's classification, specifically, whether Solana should be treated as a security, before it can be analyzed under a commodities ETF wrapper. competitive landscape and regulatory developments. The move by Franklin Templeton adds momentum to the race for a spot Solana ETF in the US. On February 11, the SEC acknowledged several Form 19B for filings for spot Solana ETF proposals from notable issuers including 21 Shares, Bitwise, Canary Capital, and VanEck. The SEC had previously acknowledged Grayscale's Solana filing on February 6, a notable development considering that the regulator had reportedly rejected multiple applications under former Chair Gary Gensler in December. Financial services firm J.P. Morgan has estimated that, if approved, a spot Solana ETF could attract between $3 billion and $6 billion in net assets during its first year on the market, a projection that Bloomberg's Eric Balchuners described as a fairly reasonable guess. This influx of capital would not only boost the asset management industry's exposure to Solana but could also help stabilize and increase liquidity within the broader crypto markets. Franklin Templeton's crypto strategy and industry praise. Franklin Templeton has previously expressed strong support for the Solana network and its ecosystem. The firm has praised Solana on multiple occasions for its resilience in overcoming technological challenges and its ability to deliver high transaction throughput, a critical feature for scaling decentralized applications. In July, Franklin highlighted Solana's performance in terms of transaction speed and capacity, while in January 2024, it lauded the robust growth observed in Solana's decentralized finance (DeFi) applications as well as the dominant activity in its memecoin sector. This consistent positive sentiment towards Solana, combined with the asset manager's strategic move to register a dedicated trust, reinforces the notion that established financial institutions are increasingly viewing crypto assets as a viable investment class. As more institutional investors seek regulated products that provide exposure to leading cryptocurrencies, the introduction of a spot Solana ETF by Franklin Templeton could set a precedent and attract considerable market attention. Broader market impact and future outlook. The registration of the Franklin Solana Trust and the anticipated ETF filing come at a pivotal time in the cryptocurrency industry. As the market matures, institutional investors are increasingly favoring transparent, regulated investment vehicles that reduce counterparty risk while offering exposure to high-potential digital assets. A successful approval and launch of a spot Solana ETF could not only elevate Solana's status among institutional portfolios but also encourage further product innovation in the crypto investment space. Moreover, the competitive dynamics among major asset managers to launch crypto ETFs indicate a robust appetite for digital assets among traditional investors. With regulatory developments gradually aligning with industry needs, and with blockchain technology proving its value in enhancing financial processes, the future of crypto ETFs looks promising. Industry watchers anticipate that the growing trend of institutional adoption will continue to drive product innovation and capital inflows, ultimately contributing to a more stable and liquid market for digital assets. The strategic move by Franklin Templeton, therefore, represents both a response to and a catalyst for the evolving landscape of crypto asset management. As the asset manager prepares to submit its filings and potentially launch the ETF, the financial industry will be closely monitoring regulatory decisions, market reception, and the subsequent performance of the ETF in a competitive and rapidly evolving market. Coinbase set to report 109% YoY revenue growth in Q4 as trading volumes surge. Digital asset researcher Coin Metrics forecasts a significant boost in Coinbase performance for the fourth quarter of 2024, predicting that the crypto exchange could generate roughly $2 billion in revenue, a staggering 109% year-over-year increase and a 65% rise quarter-over-quarter. This impressive projection, detailed in a February 11 report, comes on the heels of a remarkable surge in trading activity that has been linked to renewed market optimism following the November U.S. elections. Surge in trading activity and market optimism. Coinbase trading volumes have reached unprecedented heights in Q4 2024, with total trading activity estimated at around $430 billion, the highest since 2021. This surge is largely attributed to a resurgence in crypto trading spurred by the political climate and market optimism following U.S. elections. Notably, on February 10, crypto researcher Kaiko reported that Coinbase experienced weekly trading volumes at their highest levels in the past 2 years. Such heightened activity has provided a strong tailwind for the exchange, driving investor sentiment and contributing to the optimistic revenue forecasts. The renewed enthusiasm in the market is linked to factors such as U.S. President Donald Trump's promise to make America the world's crypto capital, which helped ignite a surge in interest. On November 5, crypto trading firm Galaxy Digital recorded the largest trading day of the year, reflecting the broader bullish sentiment that has since cascaded across multiple exchanges. Coinbase stock, COIN, has benefited significantly from this momentum, with its share price rising approximately 40% since Trump's November victory, according to data from Google Finance. Diverse revenue streams bolster growth. Beyond its impressive trading volumes, Coinbase revenue is also being buoyed by robust growth in other key areas. The supply of USD coin, USDC, a US dollar-pegged stable coin, on Coinbase increased by about 23% during Q4 2024. This growth is seen as a positive indicator, as the expansion of USDC supply not only reflects increased on-chain activity but also suggests that Coinbase initiatives, such as offering an attractive 4.5% interest rate on certain USDC holdings, are successfully attracting users. Stablecoin adoption remains a crucial revenue driver for the exchange, particularly as institutional and retail investors alike seek lower volatility amidst fluctuating crypto markets. In addition to trading and stablecoin revenues, Coinbase benefits significantly from staking services. The exchange earns hundreds of millions of dollars each quarter by supporting the staking of major cryptocurrencies like Ether, ETH, and Solana, SOL. Staking, which involves locking up crypto assets as collateral with a validator on a blockchain network, allows Coinbase to generate additional income through network fees and other rewards. However, stakers face the risk of slashing, a penalty that may occur if the validator behaves improperly, which underscores the importance of robust network security and reliable staking protocols. Earnings season and industry-wide developments. Coinbase anticipated Q4 earnings report, scheduled for release on February 13, comes at a time when several other major players in the crypto industry are also reporting their quarterly results. Companies such as Bitcoin miners Hive Digital and Hut 8, along with exchanges like CME Group and Robinhood, are set to disclose their earnings around the same period. This confluence of earnings reports is expected to provide valuable insights into the broader state of the crypto market as institutional interest continues to grow and trading volumes remain robust. The substantial increases in both Bitcoin and Ether prices during Q4 have also played a significant role in bolstering Coinbase revenue projections. According to Coin Metrics, Bitcoin prices surged by approximately 41% and Ether by 26.3% during the quarter, creating a favorable environment for trading and investment activity. This market uptrend, combined with the growing adoption of stablecoins and innovative financial products like crypto ETFs, points to a sustained period of growth for the digital asset ecosystem heading into 2025. Looking ahead, institutional adoption and market resilience. The outlook for Coinbase remains positive as the crypto market continues to mature. The increased trading volumes and diverse revenue streams are a testament to the resilience of digital assets amid broader economic and political uncertainties. With institutional investors increasingly viewing cryptocurrencies as a viable asset class, platforms like Coinbase are well positioned to capture significant market share. As regulatory frameworks evolve and more innovative products emerge, the role of crypto exchanges in facilitating market liquidity and investor access is expected to expand even further. The strong performance anticipated for Q4 2024 is a reflection of both immediate market catalysts and long-term trends within the crypto industry. Investors and market participants will be keenly watching Coinbase earnings report, as it could serve as a bellwether for the continued evolution and mainstream adoption of digital assets. With the backdrop of historic trading surges and sustained institutional interest, the stage appears set for a landmark period in crypto history, potentially propelling Coinbase and the wider crypto ecosystem toward even greater heights in the coming months and years.